Hello, everyone, and welcome back. Today, I'll be covering the reasons why I bought Pi Industries for my 2025 portfolio. But before I proceed, I would just want to tell you that I'm not a financial advisor, and this is not a buy or sell recommendation. I'm just here to analyze my 2025 portfolio, and I'm just paper trading it. I'm not actually bought these stocks. So, if you do want to buy it, I suggest you do your own research first. So, let's begin. I bought Pi Industries at 3,595 rupees on 21st January when everyone feared agrochemical headwinds. Today it's at 4,155, 17.3% up, and I believe it will still go up about 13%. So let me start by first briefly explaining what they do and what their business model is. So they have two distinct business models. Uh, And firstly, Pi Industries is a leading player in the agrochemical space. They have strong presence in both the domestic and international market, and they run two very different models in both of them. So in India, which is a domestic business, they acquired the rights to formulate and manufacture innovative herbicides and fungicides from companies abroad, right? Because they know these are successful formulations. So they get the rights of these patented formulations, and then they mass produce them, and then they sell them under their own brands to Indian farmers. Uh, and here are some of the brands that they sell them under, right? But this accounts only for 20% of the revenue. The other 80%, which is the majority of the revenue, comes from the international business, which is a little bit more interesting. So in their international business, what they do is they get orders from innovative companies who make these molecules and formulations from countries such as US, Brazil, or Saudi Arabia. And then Pi Industries figures out a way to safely and efficiently make these formulations at scale and then do custom manufacturing using high-end export grade facilities in India. So they mass produce these molecules under strict quality controls, and then they ship these via container ships to the customers who sell them under their own brand to the world. Now you might ask, why doesn't Pi Industries just create their own molecules? Well, that's because it costs a lot of money upfront and takes about 8 to 10 years to actually make any revenue on that, whereas their CSM model is has high recurring revenue and only takes 1 to 3 years. Now, if you want an analogy for their international business, it's basically, think of it like this. You have a person who creates a recipe, and it's proven that this recipe is extremely good, but they want to sell it to a lot of people, right? So what they do is they send it to Pi Industries, who runs a high-end kitchen in India, and they make thousands of servings of this food using the recipe, and then send it back to the person who created the recipe, who can then sell it to their customers. So they don't own the dish, but they earn great money being the trusted chef, right? Now, the next part of their business, which they just introduced, is their pharmaceutical business. In April of 2023, they set up a subsidiary called Pi Health Sciences. Um, Basically, they acquired two smaller companies called Therachem Research Medilab and Ar Archimica, right? And why they did this is because of very strategic reasons, right? Because both these companies have something that Pi Industries want. Therachem Research Medilab has all the regulatory approvals to sell pharmaceuticals in the US, and the one in Italy has 24 US DMFs. Now, what does DMF mean? Well, it means a drug master file, which refers to confidential regulatory submissions filed with the US Food and Drug Administration. Basically, they have all the permissions to sell their drugs in the US, like their pharmaceuticals, right? And these acquisitions were funded via a QIP. And here is the business model, right? So they design the drug molecule, they manufacture it in Italy, and then they ship it to Europe and the US. And here's why diversifying into pharmaceuticals makes a lot of sense. Firstly, because it's similar to their fertilizer pesticide business, except there are stricter regulations and higher margins, so there's more money to be made. And um, it also takes away that vulnerability of being in the agrochemical space, because this is a cyclical space, as we can see, and because it's based on agriculture, which is a very cyclical thing. And by diversifying from that, they have a more stable sort of business, right? Also, there's a huge opportunity here because it's a huge market for pharmaceuticals, and India has a cost advantage by being cheaper than Western companies, right? They also have a synergy with their existing business of agrochemicals because they can do shared R&D infrastructure, and they can cross sell to players. Cross selling means when you sell different products to the same client, right? So if they have agrochemical client like Bayer, they can also sell them pharmaceuticals. So it costs them less to acquire that customer. Lastly, it's accretive acquisitions valued at 4 to 5 times EV EBITDA. That means that it's going to boost their earnings per share because they acquired two smaller companies, but because they're a larger company, their earnings per share will increase. Now, here is a small um, comparison I did for their agrochemical business and their pharmaceutical business right here. Main thing to focus on is that the margins are higher, and the growth of the pharmaceutical business will also be higher, right? Okay, now why did I buy Pi Industries? So in January of 2025, everybody was scared of buying the stock. Everybody was selling it. Um, it fell from 3,000. It fell from 4,716 to about 3,000 rupees, and this was because of a lot of reasons. Firstly, there was weak global demand and inventory backlog, and Chinese companies were dumping a lot of chemicals and fertilizers onto the market, which were generic, and there was global oversupply of these, right? And then uh, there were pricing pressures due to lower raw material cost, because basically as raw material cost decreased, customers expected that the price of these chemicals should also decrease, right? Because it cost them less. And there were losses in the pharmaceutical segment of Pi Industries, and there was a working capital spike of 73 days. But here's why I think that the market overreacted to this news, right? Because firstly, Pi Industries has long-term contracts with clients to produce these specialized agrochemicals. So even though there was a downturn and demand was weak, they still have those contracts and that order book. So it's not like their demand has reduced drastically, right? Uh, and also, the agricultural sector is cyclical with regards to demand, uh, and eventually it will go up. Even if it goes down and global demand is weak, eventually you will need agrochemicals. uh, Thirdly, the pricing pressure is not a big concern for them because they make specialized high margin proprietary products. They had 31% new molecule growth this year, and margins were steady at 27.4%, which is pretty good, right? Because their margins weren't squeezed as much despite generic chemicals flooding the market. Also, the pharmaceutical losses are deliberate because they were making investments in their capacity, and it's a long-term play, right? They plan to break even by FY 27-28. So this is a long-term play for them, and I think it'll be a big contributor to their revenue. Also, their capital spike of 73 days may sound like a lot, but it was because of a seasonal inventory buildup for the Kharif season and to counter China's dumping risk, right? So basically, these weren't any of the concerns that we should worry about, and fundamentally don't affect the stock, which is why I bought in at that price, even though it was falling, right? Now let's understand why I bought it from a fundamental standpoint, right? Um, so Pi Industries is a company that is in an industry that has high barriers to entry because of the chemistry involved, the process, the IP, and the regulatory filings. So it's not very easy to copy. And the biggest thing I would say is the trust, right? Because you have to have a relationship with the client, and they have to trust you for doing these projects because it's at a huge scale, and you have to be dependable. So I think that's very hard to replicate for new companies, and so Pi Industries has an advantage there. Secondly, yeah, like it says, long-term visibility. Global clients give 3 to 5 year commitments. This makes earnings predictable, and that's why Pi Industries is a rare compounder in Indian markets, even though it's in a sector that is cyclical, right? Thirdly, diversification. They're going into pharmaceuticals now, and even in their agrochemical business, they have two distinct segments, right? The domestic and the international, and the risk in both of them is like basically it allows them to reduce their risk because they're in two distinct segments, and now in pharmaceuticals will reduce it even further. And they're research and development driven, massive focus on innovation with R&D centers in India, Italy, and the US. Italy recently, and the US as well, because of the recent acquisitions they made, right? And this is just a picture of all the customers and the distribution centers, retail points that they have. Now here I want to focus on the catalysts, right? Which is the acquisition of some peptide technology. Uh, on their con call, they mentioned that they want to 5x their growth by 2030, which is a good target. Uh, they're working on climate resistant crops because global warming and extreme weather events are increasing, and I think it will be a pretty huge thing if they're able to produce something that makes climate resistant crops, and a lot of farmers will buy them, right? Secondly, their pharma turnaround timeline, like I mentioned, a break even path 2027 and 2028. And this year, in fact, they onboarded two new clients, two big ones. And next year, they plan on onboarding 2 to 3 more clients. So I would say they're on their path for break even. Next, a lot of companies are diversifying away from China because of the tariffs that are being implemented, the uncertainty there is. So India is a good second option for them, and there's increasing export growth to the US, I feel, because of these reasons. And finally, macro tailwind support from government schemes such as the PM Kisan scheme and the PLI incentives. So the PM Kisan scheme actually is helping farmers. So they transfer about 6,000 rupees a year to 93 million farmers to boost their disposable incomes, and that will definitely help. Uh, increase the demand for agrochemical purchases, especially as pine industry is moving towards premium products, and so this really helps them. And if I don't know if you guys saw the last budget, but there was a lot of things that they're doing to help farmers because of this global slowdown in agriculture. Uh, so the government is really focused on helping these farmers, and I believe it will benefit pie industries indirectly, right? Also, the PLI scheme, which is basically subsidies for active ingredient production and incentives for export oriented manufacturing, that the government is providing this, right, to increase our manufacturing capabilities. And so this will help pie industries. It'll help them even in pharmaceuticals, as last budget also emphasized on that. Okay, now let's move on to the financial analysis. So here we can see that the revenue has been growing very nicely. The fixed assets have been growing, net worth, the earnings before interest and tax. But we can see here that the profit after tax for this year has actually dipped, as has the earnings per share. So this is for all the reasons I mentioned while the stock was falling. The global demand was subdued. There was flooding of generics in the market, and basically all those issues, right? So next, let's do a quick peer comparison. Um, so I found this website which has done a quick peer comparison with similar companies in the space. So as you can see here, Pi Industries has higher profit after tax, higher margins. They have higher ROE than two out of three of these companies, higher ROCE than two out of three, and has the lowest price to earnings ratio. So from that point, it looks good. And then if you look at the sector average as well, if you take the whole sector, they still outperform in revenue growth and EBITDA, in ROCE, and in debt to equity, right? So it's like the stock is really good, so it demands a premium valuation, which is also something that we will see in the valuation. So this is a discounted cash flow analysis that I did, and it basically discounts the future cash flows of a company to find out the price of the stock today. So here are some of the estimates and some of the assumptions that I made. And if you want a separate video on how to make a discounted cash flow analysis, let me know. And basically, what I found was that it is 36% overvalued, which is surprising, right? Considering uh, the price to earnings ratio. If you look at the PE ratio, if you look at the 10-year PE, the median PE is 39, but the PE right now is 37. So it's still not even at the median PE. And in fact, if you look at the 5-year PE, it's 46, and right now it's 36. So uh, I don't think the price is actually caught up with the median PE, and which is why it's interesting to see that the stock is actually uh, overvalued from that standpoint, right? So to cross check, let's just go to this website called Alpha Spread, which basically does the valuation based on the DCF also, and it's exactly the same, right? They say it's overvalued by 36%, and that's the base case. Worst case, it's overvalued by 45%, and best case is overvalued by 19%. Now, if it is the best case, then there's a long way to go for the stock. But if it's a base case, then it's hard to say where it will be, right? Like based on this. So let's look at this chart. It basically shows how it has been relative to its intrinsic value, and we can see that. Like look at this. It's 50% overvalued here. It's at its lowest is 22% overvalued, right? So on average, it has been 39% overvalued throughout its life. So we can see that the stock commands a premium valuation, and right now it is 36% overvalued, right? So that's still lower than the 39% overvaluation it usually has, right? Which is to say that it's not like this is not really a big concern, the valuation, because of these reasons, right? Now, finally, let's look at what the company is saying. So they're saying that the margin drag is one-off and developmental. So they're saying that the revenue degrowth is on account of inventory pile-up and deferred offtake of key products, and the gross margin drop-off was due to old inventory write-off. So they're just giving reasons for why this is not really a like a trend that's going to take place, that they're going to lose revenue or they're going to lose margins, right? And if you look at the outlook, it's actually good. They are good traction on new CRDMO inquiries, commission of kilo facilities in Italy, and improved order book visibility over the next 1 to 2 years, and expect to achieve 75% revenue growth in FY26 with improved margins. Now, if that happens, I believe that will be a really positive catalyst for the stock, because 75% revenue growth is pretty massive, right? Now let's talk about some of the threats that this stock has. I would say tariffs from the US are a threat, because the last time we had 20% tariffs implemented on chemicals, the stock declined about 6%. Luckily, they were paused, so it recovered, right? Um, but you know, it's likely if they're implemented in India, they will be implemented in China, which could be beneficial to us because if they implement it on China, it's usually higher for China than India. And Yeah, so it'll be a mixed reaction, I believe. Like the stock market will have a mixed reaction to this news, but hopefully India and US can strike a deal and keep the tariffs low or just eliminate them altogether, which is optimal, right? Another risk the is that a lot of uh, pyroxasulfone patents are expiring, which is some chemical that Pine Industries produces in US markets, in China, and in uh, in other countries basically. And the thing is, it may have a negative impact on the stock price because it is uh, it does contribute a lot to their revenue. But I believe a company like Pine Industries, where they keep innovating and keep coming up with new products and keep patenting them, it's not really a big issue. Like the fundamentals of this company are solid, so I'm not really very concerned about that. Another risk is pharmaceutical segment of their business has delayed break even. Like they said, break even in 27, 28. But if it happens later than that, then people might react negatively to that news. But I think they're on track to break even by that point, if not earlier. So it doesn't really concern me. Also, if you want to read more about this, I'll drop all these links so you can read up more if you want about the stock. Um, let's go on to the next slide. So these are the price targets from the last closing price. I collated these from a number of websites with all the links and everything. If you guys want to check it out, trend line says there's a 1.26% upside. TradingView says average downside of 32.51% with 25 analysts analyzing that. And I don't know if TradingView also accounts for the valuation because this number is very close to the 36% overvaluation that we saw, right, in the valuation. So maybe they're using some kind of metric there. Um, but yeah, that is interesting. Motilal Oswal Financial Services says an upside of 25%. Morgan Stanley says 20%. And my target to reach 30% is only needed a 12.6% upside from here, right? So, I mean, the market seems to be a bit divided, but yeah, you guys should go check out some of these reports from Motilal Oswal, Morgan Stanley, and everything. Read up on those. This is my LinkedIn and my email if you guys want to get in touch. And finally, I just want to thank Anne, Julian, and Aniket for helping me out and helping me research this project and just doing a lot of work on this. So thank you to all of them, and thank you for watching this video.